Well, friends, good morning. So, we will discuss today the deposit insurance in India. Deposit insurance in India. In the recent period, India has been in the forefront of designing and implementing a preemptive deposit insurance framework that shields small depositors of banks from financial distress on account of bank runs or failures. Accordingly, the theme of this policy is that this subject assumes considerable importance and in the context of bank failures in some jurisdictions in March 2023, that have posed new challenges for the conduct of monetary policy as well as for prudential regulations and supervisions. So the swift and decisive response of deposit insurers and regulators to quell the turbulence and contain contagion are redefining the landscape for resolution and deposit insurance in the pursuit of financial stability. So see what the deposit insurance in India is. Deposit insurance in India in a cross-country setting. The idea of deposit insurance was shaped by intermittent bank failure between 1948 and 1960. So a Deposit Insurance Act was promulgated by Parliament in 1961 to set up the Deposit Insurance Corporation, a wholly owned subsidiary of the Reserve Bank of India, the country's central bank. So it was merged with the Credit Insurance or Credit Guarantee Corporation of India and renamed as the Deposit Insurance and Credit Guarantee Corporation, that is DICGS, on July 15, 1978. So with the mandate of insurance of deposits and guaranteeing of credit facilities and for other matters connected therewith or incidental thereto. So from its very inception, the corporation was envisaged as a playbox plus institution. The credit guarantee function was discontinued in April 2003 and the deposit insurance became and remains the principal function of the corporation. The resolution function resides with the RBI as the regulator of the financial sector. Currently, the playbox plus mandate is restricted to the provision of financial support in case of the mergers. More recently, however, this mandate has been strengthened with amendment to the DICGS Act in August 2021, which provides for upfront payouts within stipulated timelines. So this provision is unique among deposit insurers. The corporation is now liable to make payment to depositors of a bank facing solvency stress up to the deposit insurance limit within 90 days of the peak bank being placed under regulatory directions that restrict it from discharging its liabilities. That is even before liquidation and amalgamation. So the insured bank has to submit the depositors list within 45 days. The corporation has to get the genuineness and authenticity of the claims verified within 30 days and pay the depositors who have submitted their willingness to receive the same within the next 15 days. In case the RBI finds it expedient to bring a scheme of amalgamation or compromise or arrangement reconstruction, the liability of the corporation will get extended by a further period of 90 days. So globally too, the mandate of DI have expanded significantly with the share of paybacks and titles shrinking. By 2023, it was down to 70%. Increasingly, DIs have been vested with additional responsibilities, including for financing and resolution, in recognition of their crucial role as participants in the National Financial Safety Net. So consequently, the share of DIs with the Playbox Plus mandate has risen to 48%, a rise of 11 basis points in 10 years, especially among advanced economies. So the shares of loss minimizers and risk minimizers have remained broadly unchanged. So as far as coverage is concerned, it may be apposite at this juncture to set out some stylish facts about deposit insurance coverage in India and how they compare with the global experiences as recently clarified by the IADI. So in India, deposit insurance is mandatory for all banks, including foreign banks. Currently, 1,997 banks are covered, comprising 140 commercial banks and 1,857 cooperative banks, which are small financial institutions owned and controlled by their members and are community focused in their operations. So according to the IADI's latest deposit insurance survey, this is the largest number of deposit taking institutions covered by deposit insurance in the world. Second only to the US, the current insurance coverage limit is INR 5 lakh, approximately US dollar 66,000 per depositor in a bank. So expressed as a multiple of nominal GDP per capita, this works out to 2.9 times as against the global median of 3.3, but it compares favorably with the medians for payback and risk minimizers DIs. On a by account basis, the coverage ratio in India at 97.9% is in line with the global median and a little below the later 44.2% as against 47% globally in terms of value of deposits. As far as funding is concerned, funding for deposit insurance in India is in line with the global central tendency under which 96% of DIs are funded by levying premiums on member institutions, 64% of pre-tax accretion to the fund. So in addition, about 35% of the accretion to the deposit insurance fund came from investment income in fiscal 2022-23. Unlike the growing practice worldwide of nearly half of deposit insurers levying differential premiums, incorporating additional risk measures up from 30% in 2010, a flat rate premium of 0.12% per annum is levied in India, which has been revised from time to time. Keeping in view the adequacy of the corporation's DIF, the size of fund measured by its ratio of insured deposit at 2.02% is comparable with the global median. The corporation has targeted the achievement of a ratio of 2.5% by March 2028, means 2028. So as far as reimbursement is concerned, the reimbursement of insured depositors is the core responsibility of a DI, with the IADI promoting a period of within 7 days as its core principles 15. So there has been a significant improvement globally in the speed of reimbursement, although meeting the core principle has remained a challenge over the last decade. So the global average period for reimbursement to depositors has reduced from 28 to 14 days. Currently, the DI-CGS reimbursement takes about a month on an average. So factors that usually impede fast reimbursement include data quality issues, identification to insured depositors, and depositors lacking an alternative bank account. So new vistas for deposit insurance in India. The March 2023 banking turmoil and its aftermath prompted policymakers to refocus on design features of deposit insurance processes In India, this has led to prioritizing risk management, especially during adverse market conditions, while benchmarking to best international practices. This involves revamping risk management and internal control system, including contingency planning and crisis management frameworks, and alignment with the IADI's 2020 guidance paper on risk management and internal control system of deposit insurers. In the context of the DICGS's portfolio valued at $24.5 billion, treasury operations are being reinforced with asset liability management tools, real-time monitoring of liquidity and concentration ratios, and periodic value at risk and scenarios analysis at various confidence levels. So a dedicated market risk reserve has also been created. Some risk management measures like market borrowing, liquidity support from central bank, government, etc. may necessitate changes in statutory provisions. Simultaneously, public awareness campaigns are being refashioned and stepped up, driven by a board-approved communication policy. Public awareness about deposit insurance is being nurtured through continuous dissemination of deposit insurance related information. All insured banks are required to display the DICGS logo and QR code linked with the DICGS website on their own websites and internet banking portals. The corporation has also registered on a hyper-local social platform which facilitates sharing of specific information on claim payments. Messages are also relayed by structured mobile phone text. The website itself is being overhauled to make it more customer-friendly in terms of search capability, information architecture, improved users' interface experience, content strategy and user engagement, a progressive web app and the like. So the digital information of all operations is underway with a focus on data management, process optimization, business analytics and cyber security with the best-in-class market technologies, straight-through processing without manual intervention and seamless integration of various modules are on the unveil alongside use of application programming interfaces and artificial intelligence. A standalone single customer view application will reduce time lags in the submission of claims. An in-house recovery dashboard enables tracking compliances and authentication of asset details and payments by liquidators. So looking ahead, the revolution of the deposit insurance function is likely to confront more complex challenges amidst heightened uncertainty. For instance, climate change is emerging as an overarching risk to the global economy and financial system. So according to the IDI survey, 60% of GIs have formulated or formalized environmental, social and governance policies, and some are members of the network for greening the financial system. This is what is keeping us awake in India, framing a comprehensive ESG policy, incorporation elements of climate sustainability, investment in sovereign green bonds, measuring the impact of climate change on default risk and contingency planning for climate-related extreme events via actuarial analysis. We are exploring appropriate coverage for green deposits, climate risk-based differential premiums, and ex-ante funding needs for climate sustainability. So these new challenges will inevitably require effective coordination and information sharing between DIs and other national safety net participants as well as with those in other jurisdictions. Forums like this one will be the incubators of global coordination. The time to act now is there. So, foreign deposit insurance amid climate change is an important issue today because climate change related financial risk necessitate a proactive and dynamic approach from deposit insurers to strengthen crisis preparedness and management. There is a need for deposit insurers to be involved in central banks' real-time discussions with their REs instead of being a back office input. Furthermore, a deposit insurer should prioritize international cooperation and knowledge sharing to address the global nature of climate risk. Collaborative efforts can facilitate the exchange of best practices harmonize regulative approaches and foster sandbox regulations across global financial markets rather than just domestic sandbox approach. Thank you very much.